Hey YouTube, hope your day was good. Today, it's tax time of the year. We're going to talk a little bit about taxes, tax accounts, and then look at some net effects on investments and the different types of tax accounts. A lot of times you'll hear one is particularly better than another one, or, a third account is, the best. And we'll see how those kind of play out, and then look at some tax implications in some of the businesses that I'm in, which are sales, real estate, investments, crypto, and I also have a regular job. So kind of the gambit of how you can be taxed. So we'll get right into it. Similar sheet to how I showed on the last video. We have sales, real estate, investments, and crypto. If you look at first the sales business, I run one of them from my house, and I don't know if you have a home office that is your primary location that you're operating out of. There's a $1,500 straight deduction you can take on that home office, and at a 25% tax federal, state, and FICA. I put FICA in here for 6%. Just sometimes FICA includes Social Security, sometimes it includes Medicare. I just use the Social Security portion. And that gives you a savings of $570 on your taxes, simply having a business at your house. If you have, let's say, expenses on that sales business, let's say you had to buy a computer for the sales business, or a monitor, or tape, or any supplies, that's also deductible. So let's say you had $2,000 in expenses. That's another $760 in savings. Sorry. NWA Soccer Shack is run at a separate location, and that is a self-controlled kind of LLC. It deducts the expenses, and then I kind of get a K1 distribution from that. So there's not really anything you could take against the K1, so there's no real tax advantages in that. Closeouts, similar way. I get a thing from the golf shop, and I can take some write-offs on that because I have some expenses related to tracking on that, and also there's also sometimes write-offs on merchandise that doesn't sell that you can kind of choose which year it basically is disposed of, and that is a possible savings on that. In real estate is really, we talked about before, it being really geared around your net worth increases. Now, you can also get cash flow and profit from real estate. So let's say you put $100,000 down on a $100,000 profit property. That would definitely create profit and cash flow. But let's say you go the normal route and you put $25,000 down on a $100,000 property, then you're probably more looking at a net worth increase over time, and a small amount of profit maybe because of expenses and things. And you probably won't have to pay taxes on your profit. The reason for that is in real estate you have something called appreciation. You take that $100,000 price on the house and you depreciate it over 27 and a half years, which we'll say comes out to like $3,000 a year of straight deduction. For that deduction, you don't pay any of these on it, so it creates about a $1,140 tax advantage for that depreciation. So if you go and you buy 10 houses, then you're $11,400 up from a tax standpoint at the beginning of the year before you have any kind of profits to start. And so from a tax standpoint, generally you're like break even though you have some profit coming in and a net worth increase. You can also, when you sell, do a 1031 exchange. I showed you guys how I did one and now two of those to shift from the sale of a property into another property without paying taxes. If you upgrade, so this year I had a air conditioning unit replaced on one unit, and there is accelerated depreciation on that, and so I spent I think $5,500 on that, and and I spent $5,500 on that, and so roughly a third of that would be a tax deduction. We can figure the amount here would be $2,000 off of my taxes due to that expense that I had and the way that they're treating that tax wise. 1031 exchange. I sold a property worth $200,000-$300,000, and I didn't pay tax on that. I rolled it into a new property. And sometimes people, what they use that for is, they'll get a house and they'll pay it down halfway, and then they'll say they have $80,000 equity in it. They'll sell it, and they'll 1031 exchange until it's, say, a quadplex or a duplex, and use that money as kind of the down payment on that higher cash flow property. And so that's a tax advantage. The biggest one that you'll get, but your kids will get, is step-up basis. If you file your real estate as a pass-through on your personal return rather than a separate corporate tax return, when you die, your kids will inherit it at a stepped-up basis. So let's say you paid $100,000 for it, depreciated it down to $40,000. Then you die, it's worth $250,000. Your kids now get a $250,000 basis in that property and can then depreciate it back down, so nobody pays the difference of $210,000 in taxes. So that would be a savings of $80,000. Pretty significant advantages to real estate. Now, let's come down here to investments, and you've heard about some of these accounts. You have a 401k, which you pay the FICA up front, but you don't pay federal and state taxes. So what this represents is, over here is what you are getting from tax savings up front, and over here is what you're getting from tax savings down the road. And so up front on 401k, you're paying this and this tax, getting these savings, and you're paying the FICA. Down the road, when you withdraw, you pay the FICA. You get the FICA advantage because you paid it up front already. Okay. So Roth IRA, education IRAs, Roth are, after you take out, you don't pay taxes on that, and when you put in, you get no tax deductions. Same with education IRAs. HSA, you get the tax deductions when you put in, you get the tax deductions when you take out. Best type tax account, and we'll talk about how that works out as far as returns. I have a little formula down below we can look at. And then UTMAs is where you have an account in your kid's name, which is maybe their money, and you aren't really taxed very much on that account because it's in the kid's name. They may not have to file taxes, so it may be under $600, things like that. Brokerage account, there are no tax advantages, but there are some advantages to investments like real estate or these that are not based on taxes. So we'll talk about that. Crypto, brand new into crypto. Don't know what the tax advantages are. Aren't seeing any tax advantages at this point. So let's look at down here and just compare the regular money that you have, like in a brokerage account or in real estate, to the 401k, to the Roth IRA, and to the HSA from a return standpoint. So what this says is this takes and says you have a 10% return on your investment for 10 years. The regular account, you're taxed at your regular rates, which is about 38% if you're in a 25% tax bracket up front. When you sell, you're taxed on the gain at also 38%. So I added this back in for your cost basis. I added back in your cost basis into this one. And if you put $7,200 into a brokerage account, you get these returns for 10 years. Because you're taxed up front, the $7,200 actually is less than the $7,200, if that makes sense. And then you're left after 10 years of return with $9,301. Okay. Now, when would this be an advantage? We'll talk about that. 401k, same situation. You're taxed up front at 6% on FICA. You're not taxed on federal or state. On the end, you are not taxed on FICA. but you are taxed on federal and state, and so you're left with $11,937. Roth IRA, you are taxed up front on federal, state, and FICA. You're not taxed ever. So this is your total on the Roth IRA, slightly less, just because of how the math works. HSA, you're not taxed up front. Your growth occurs, then you're not taxed again. So this is the amount that you're left in your HSA account. Now, HSA is restricted for health purposes, if you use it for that. Education IRAs for education purposes. Roth IRA and 401k. I have another video about a 72T provision, which allows you to access that, even monthly distributions, for an early retirement. So if you're 50, you can retire on your 401k. You're rolling into a Roth IRA, but that I go through that in another video if you look at my videos on 72T. Now, the one thing I wanted to show you was when I first started investing, I really pumped the 401k and the Roth IRA. This is where I was using as my vehicle. I really didn't have anything in my regular or any HSA. Over time, I first shifted away from Roth IRAs and started putting money into regular and my HSA. Okay? Now the HSA, you see it for the tax benefit, and so the order that I would max these out in is number 1. You're going to max your HSA. Now, the reason you're going to max your HSA has more about risk than about the total value, which I'll show you in a second. Okay? Now, I also put money in my 401k second to get the upfront tax deduction, which gives me frees up money for other things. And then third, I actually have the regular account, and fourth, I would do this, but I really don't do this anymore. Now, here's the reason, okay? Now, I'm going through and I'm looking at these taxes, and taxes can be important, but taxes are percents of return. So I start putting money into this real estate investment up here, right? And my returns on the real estate, because of how I'm doing real estate, which is, low cash flow, low profit, high net worth push, my returns maybe move from 10% to more like 33%. And so if you look at my after tax amount in a regular account with that return after 10 years, you're looking at $54,000 as opposed to a max of 18, 11, and 11 down here. And so the reason that is that inside 401ks, your investments are pretty much determined to be stocks, bonds, or things like that. You're not going to leverage those returns. You're not going to get into, I'm looking for a year for a good investment that I can make really good money in. There's no advantage to sweat equity. There's no advantage to anything you can do with your knowledge. It's made to just put it there and forget it. Now, that's an important aspect of investing because it controls behavior. But once that behavior is under control and you start seeing these type of returns, then the amount that you have in this account, and this is really just 1 year's contribution, is really important. So then if you look at this and you say, okay, if I had 100,000, then I'm going to put in over 5 years or something. Then you start to look and say, all right, 100,000 put into these different accounts. Now that becomes a difference of $500,000 between your HSA and your regular account. Your 401k may be fine, it grew, and that's great. It controls your behavior, but if you could actually have money in your hands and not spend it consistently, like in that separate account that ads you create, then you can get higher returns on your investment and end up in a really much better place than you were before. So I just wanted to take a few minutes and go through that, kind of make sure that you guys understood Number one, what I did when I was probably in the situation most people are in, and how I invested, how I maxed out Roth IRA, 401k, and kind of got that started. And then, what decisions led me to transition to a more taxable account investment strategy. And then across the different businesses, what are the big advantages? Now, for tax purposes, this sales business is taxed on profit. So you can buy $10,000 in merchandise, you can sell $2,000, make $2,000, and be taxed on that $2,000 at a third, 33%, let's say. So now you're paying $600 and something taxes, and you're still out $8,000 cash flow. Okay, so this one may have we'll say a 5-year growth process to get to a point that you're having a positive cash flow as we're reinvesting in the business. This one, it really depends. I mean, my ratios are such that I'm trying to kind of push the cash flow down, decrease my cash flow, cash coming out of real estate, and kind of allow it to grow and push the net worth aspect. So I have small profit, small amount of cash flow to cover my risks, but most of my gain in real estate is based on the net worth and the increase in values of the real estate. From an investment standpoint, pretty much these are tied up in these accounts. My traditional Walmart stock account, which is like a work deduction, is a lot of times where I'm using to fund the real estate and some other businesses, and now they kind of fund each other. And then the crypto, I really funded from, pulling some of my investment out of the real estate and starting to fund that, and also funding it from some cash flow and, specific money coming out of the sales organization at that point. This is what I did. If it's valuable to you, like or subscribe, and maybe it gives you some idea of, in practicality, how these numbers actually work, how the taxes can be to your advantage, and also when you should shift from that tax advantage being an important thing to maybe it being a secondary consideration. I'll talk to you all later.